Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC-registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Hi, everyone. Welcome to the latest Carson's, not take 5.
No, it's facts versus feelings.
Facts versus feelings. You think I know what we're doing here.
You took a week off and you forgot
already. Forgot
right.
everything. Forgot everything. Episode 113. We're going to have some fun. Sonu's back. I'm back. We've been traveling, doing things. We're going to talk about some bulls, some bears turning into bulls. We're titled this one, Now the Bears Turn into Bulls, after a 70% rally in 2 years. Back-to-back 20% gains. All of a sudden, they're saying, sorry about that. We'll talk about it. So Sunday, this morning we do our morning call with our advisors, and I start clicking all the buttons and everything, and then it's like, you have to change your password. Like, there's never any hey, by the way,
never a good time for that.
By the way, like, you have to change it by next week or 2 weeks from now. It's like you have to change right now. So I changed it. Luckily, we got through morning call, but then we had a team call, and I could only get in through my phone on a Teams thing. I couldn't get in through my computer. I'm trying to figure out what it is. I don't get it. I just don't
hate
get
that.
Yeah.
I just hate that because I have to change it everywhere. I have to change it on my phone. I have to change it on the different computers, and it is a mess. It is, the only thing worse than that is, I guess, your computer doing an auto update just before you have a call with, hundreds of advisors.
Right. And we've all seen.
That's happened to both of us.
We've seen that. I've always been dreading the day. It'll happen. I've got a C hit like in 6 minutes, and the computer says, no. You're doing a mandatory update right now.
You don't have a choice.
It'll happen soon enough. But so you and Barry filled in last week. I listened to it. Great job. I enjoyed listening to it. You and Barry covered a lot of bases, but we're going to cover some bases too. So we'll start again.
All right.
This week's episode 113. Talk a little bit about some bears that are turning into bulls. How worried should we be? Talk about strong December so far. What can happen the rest of the year? Markets in general. Sonu, you've done a lot of work on the labor market. We had the jobs number last week, and that kind of falls into some inflation data coming in and the Fed coming out as well soon into next week with the potential Fed cut. We'll get your opinion there. But let's start with it. David Rosenberg, well-known bear, actually known as Rosie, who seems to, it is what it is, looks at data and has a negative take on most of it for almost 15 years.
Rosie's never Rosie.
Yeah, I think 15 years now. Came out and kind of said, I think I'm sorry. It wasn't an official, like, my bad. Kind of said, it's because of AI, and I missed this or missed that. We've been sharing.
Did you say it was because of AI, or
that was part of it? That was in there. That was in there. Okay. That was in there a little bit. I've got like a quote. I was going to make sure anytime you do this, you'll make sure you read it correctly. So
I feel bad. I don't want to mock someone for this, but it gets to, like, all of us look at the same data. And it's amazing what different conclusions we draw from that data.
Well, exactly. High time to stop pontificating all the reasons why the market's crazily overvalued and all the reasons to be bearish based on variables I've relied on in the past, from valuation to sentiment to overcrowding positioning. I'm going to start doing is assessing what the market is saying. Oh, there you go. That makes sense. Because the market can certainly move to excesses in both directions. And you can go out and look at a lot of it. We've seen this before. JP Morgan was bearish, they changed. Morgan Stanley was bearish, they changed this year. Paul Krugman, who's known for many things, mainly being wrong about everything he's practically ever said, it feels like. He came out and retired. I don't know if he was forced out or not. He's the one that said the internet would be nothing more than a fax machine. And you can go back and look all these things up. These are happening. So we're starting to see some bears that are saying, I'm sorry. Maybe it's not my fault, but kind of my fault, or outright retiring.
Brian Westbury, no, he's not. I don't think he's ever bullish. But as long as he's looking at M2, I don't think he'll get bullish.
Been a little skeptical for 70% rally. We'll put it that way. So anyway, what's your take on this? Looking at some of these bears that are saying some of these things. I don't know. What do you think, Sonu?
The immediate reaction is, wait, should that be contrarian? But like, we've talked about momentum. What do you need for momentum? You need trending markets. What do you need for trends? You need everyone piling onto those trends, because that's how things trend, right? So everyone, I don't want to say hurting, at least to start off with, I don't think it's a bad thing. I mean, I'm just looking at all the sell side targets, right? Deutsche Bank is 7,000, HSBC 6,700, SocGen 6,670, BOA is 6,666.
There it is. I was going to say the 6,666. That's an interesting one.
Like, but so here's the thing, right? Given where the S&P 500 is right now, it's about 6,000 or so. 6,500 would be a 6.5% gain for 2025. 6,600 would be an 8.2% gain. 6,700 is 9.8%. So you think everyone's clustered around the average annual return of about 9%. But as you've, put it out there in one of your the charts, an average year isn't so average. I'm literally staring at that right now. 4 years over the last, 70 years, 74 years have had a return between 8 and 10%.
Average.
That's incredible. 4 out of 74 years. And all these sell-side targets are clustered around 8 to 10%. So, I don't know. At least they're bullish. So, there's something in their framework has obviously changed. They're bullish about the fact that they, maybe animal spirits are coming back. What's interesting is what they've missed over the last year. Even last year, they weren't as bullish as they are this year. But they kind of nailed their earnings estimates. If you think about total returns for the S&P 500, what's it made of? We've talked about this before. Earnings growth, multiple growth, and dividends. Set aside dividends, right? So earnings growth, most of these guys actually nailed pretty much, to the left. It's there. But then valuations is where they mess up, right? Or I mean mess up very colloquially, but where they, that's a part they don't get wrong. But I'm always like, look, earnings are going up, margins are going up, people are more optimistic. Usually we get multiple expansion there. So yeah, I'm like, if we do get a strong year for earnings, chances are it will be a big year and it's likely to be above 10%. That's just me.
Yeah. Fortunately, just you've been right for a while.
Or us, I should say.
Yeah. 2 years ago right now, right? What were we hearing? We were hearing the bear market. And believe me, this was universally agreed upon because we took a lot of body blows and arrows for saying the opposite, that the bear market wasn't over. It was just a bear market rally. The recession was nearly imminent. I mean, like everyone was talking yield curves and LEIs and ISMs under 45 and all these things that have always predicted a recession before, leading economic indicators. The median strategist, according to a Bloomberg survey this time 2 years ago, was looking for negative returns in 2023. Never happened before. Went back after like 15, 20 years. Never seen the median strategist looking for negative stock returns. Here we are, Sonu, 2 years later, up over 70%, looking at the first back-to-back 20% gains since the late 1990s. And it's just funny how sentiment works. And now we've got some optimism. I've said before, you need bulls for a bull market. And we've got some people coming in. I think I look at it like this. I think it was December 12th or 13th. You can look that up to make sure. But when Alan Greenspan gave the infamous, whatever you want to call it, irrational exuberance speech, everybody knew.
Is that 96?
96, sorry. It was 96, correct. So that was a really big rally in 95, solid rally in 96. Said it was irrational exuberance. All stocks did was like double from that level. All the NASDAQ did was up several 100%. I got into the industry in the late 90s. I guess people figured it was a bubble, but hey, it kept going. We do not think now is a bubble, and be very, very clear. But some of those internet names back then clearly were very bubblicious. So just because you're overvalued doesn't mean it has to stop. I mean, what do we see in the mid to late 90s? We saw strong productivity. We saw strong earnings growth. We saw a major new technology that was coming that was just going to break the mold and create so many new things. And the internet then, sound familiar now? It sounds awfully familiar now, but now we've got AI. And again, what Rosie said, I mean, he said, AI helped some earnings. I mean, there's some legit good things coming because of what we've seen in AI and better productivity.
That, right? I don't even buy that. I don't know, like AI's helped earnings. I don't know if that's true. Like, but
not yet.
I could be wrong. Yeah, exactly. But that's the thing, right? AI, I think, is the icing on the cake to come. But when Rosie says like AI's helped earnings and that's why I missed out, no, I don't buy that. But anyway, it is what it is.
Okay. You gotta say something.
You have to say something.
You gotta say something.
That's true.
All right. So anything else on the? So I'll put I'll kind of give my take. Yes, near term there is some froth. All right. We have the 5-day moving average of the CBOE put to call ratio is near the lows this year. So options traders are maybe a little optimistic. Remember, Sonu was all over the fact we saw puts coming in. We saw a higher VIX ahead of the election that unwound to the massive rally that we've seen since the election. The VIX was sub 13 just last week, so volatility is a little on the low side. Ned Davis Research, they do a sentiment composite, looks at various different things that's in there. It's in the excessive zone, not too much of a shock there. Something called the Economic Optimism Index. Investor Business Daily does it. Highest since August of 21. I know various sentiment polls, small business sentiment. I know Consumers Conference Board has this thing. What do you think the stock market's going to do?
Right.
It's like people are extremely bullish. Yale does one that's kind of the reverse of like how what's the odds of a crash, right? What's the odds of a crash? According to this Yale survey, like the lowest we've seen in a long, long time. I don't think any of this should be surprising. We've had a heck of a run. Maybe we need a little bit of a pullback, volatility, an early August type of scenario where you have this 3-day shakeout that scares everybody. I don't know what it's going to be, but maybe that could be coming. I'm not sure about December. It might be early in the first quarter. What do you think, Sonu? Am I on something there? Or
I want to ask you about that because you wrote something, and I don't think
I write a lot of stuff. What'd I say?
This is for the outlook, but I don't think I'm giving too much away when I quote that. But you wrote like this year, the biggest pullback we had was 8 to 9%, something like that. You haven't had a 10% pullback, and I'm thinking of your chart that 10% pullbacks are pretty common. At least once a year, maybe twice a year. 5% pullbacks at least 3-4 times. We haven't had that, so 2024 is really very low volatility in terms of market moves. I'm curious, what do you think about? I mean, I get the whole thing about just because we haven't seen something doesn't mean we'll see it.
Right.
But still, given the run up in stocks and, optimism, whatever you call it, animal spirits, the beginnings thereof of animal spirits, curious if you think we'll see that 10% pullback in maybe first half of 2025.
I do. The short answer. I mean, I think we will. I mean, we've been pretty spoiled, right? We've been pretty spoiled. And it's normal. I mean, the average up year for the S&P 500 is like 19%. So it's, again, if you're positive, just average that. The average down year is 13%. So it's pretty wide dispersion there. And again, like you pointed out, only 4 times the last 75 years have stocks been about average, between 8 and 10%. Average is somewhere around 9, low 9s or so. Going to be higher after this year, though. That's how we had this year. But again, I think it makes sense. I mean, I use the quote a lot. I like the quote Churchill. Plans are useless, but planning is everything. When I get in front of people, I say, it's still a bull market. We're still optimistic, but plan. Every single year, put it this way, every year, come into the year thinking we might see a 14.2% correction peak to trough. You know why 14.2? Because that's the average since 1980. Okay, yeah, lots of years it's less, and there unfortunately are some years it's more. But if you come into the year thinking there's going to be a double-digit return, double-digit return, yes, but double-digit peak to trough correction at some point, and I think next year the odds are higher. Why? Because we didn't have one last year. Eventually, red, black. It's not gambling. I don't want to make it sound like that, but eventually it's going to happen. And I think that makes a lot of sense to prepare for that. And that's not the end of the world. I mean, look, again, the late 90s, we saw a lot of volatility in the late 90s, but stocks did continue to go higher.
I think even 97, right? You just talked about Greenspan's 96 comment about irrational exuberance. Markets doubled after that over the next 2.5 years or so.
Yeah.
But 97 was a pretty volatile year, I think. I mean, it's 98 too.
98 had a bear market. I mean, 98 had a bear market in long-term capital management and big worries. And, anyway. Yeah, so we'll see. But as we've laid out, we're still bullish. We're still pretty optimistic. But hey, we're up I think almost 30% total return on the year on the S&P.
Off the top of your head, have you ever had 3 continuous years with 20% plus returns for the S&P 500?
Yeah, we had 5 in the late 90s. I mean, on a total return basis, so it's including dividends, total return. There was a 5-year period in the late 90s. 95, 96, 97, 98, 99. Yeah, there it is, 5. And then what did that do? Negative 3 years in a row, 2000, 2001, 2000. I mean, that's just kind of the way these things work. So, I think I wrote a blog on it on our website somewhere not too long ago, looking at 20% years. And yeah, I mean, it can happen. And by the way, so again, this is usually total return now. On a total return basis, you're up 20% for the year, 2 years in a row, like we're probably going to be this time. That next year, Sonu, it's only happened 8 times, only 8 times. Okay. That next year's been higher, 6 of them. Not bad.
All right.
The average return of the next year is 12 or 13%. Again, that's a total return.
So above average.
Above average returns. And 75% higher on the years, about your average. I think it's higher, 71 or 72% of the time. But, about average. So I put it like this. just because we're up 20% 2 years in a row does not mean you should be bearish because just that. Maybe there's other reasons to be bearish. I mean, but you guys listed some last week. I wouldn't say bearish, maybe cautious or things to be aware of last week when you and Barry talked about the 3 things that we were kind of potentially worried about. But don't worry about up 2 years in a row, 20%. You know why? Because it can keep going. You want to add anything else there?
No, that shouldn't be. Momentum should never be on your list of concerns.
Yeah.
Right? Like, momentum's a good thing.
Unless you're not in it. Yeah. One more thing on this, to beat a dead horse and maybe finish it. We've got 57 all-time highs on the S&P the time we're recording this. The previous 2 years, that's 2022 and 2023, a grand total, drum roll please, one all-time high, 2 full years. 57 is a lot this year, and then you take a look back. And the average 3-year, I looked at this, like the average number of all-time highs in any 3-year period, like 55, all right? That's like, we're right there average the last 3 years. And I get it, this year's been incredible, but it's because we had such a rough couple of years before. 23 was great. All we did was made up those terrible losses we took in 22. Okay, so again, just put some context around this because our friends at Ned Davis did a great study. The years at a 50 or more all-time highs, that next year was down on average, only 96. I think it's 5 or 6 times. I forget exactly, but only 96 was in double digits. So 95 had more than 50. 96 was up double digits. That's the only one time, only once up double digits. And I took a look at it and said, well, yeah, but look at the previous 2 years. Yeah, right? The previous couple times you had a bunch of new highs. This time was not, 4 most dangerous words. This time is different. Well, this time is a little different because we didn't have a massive run going into it. So now let's see here. Anything else on the stock market / sentiment backdrop you want to touch on here?
No, I think we're good. I mean, I won't complain. I know there's always a contrarian signal, like we said, but always everyone, suddenly bullish, and that means should we get bearish? But, hey, we want trending markets and we want more bulls, and, to your point, a bull market needs bulls, and that's where we are at, hopefully.
Yes. I'm going to try to find it. Remember Michael Burry, the gentleman who called he
was in The Big Short, right?
He was in The Big Short, made a lot of money.
Movie and
he
the
was
book.
all over it. I mean, he came out, I think, like in 23, and all he said was a tweet, and all it said was sell, right? I mean, now, what does that mean? I mean, did he really sell? Did he do this? Did he do that? I mean, we've seen these little nuggets of, oh my goodness, before, and none of them have necessarily played out yet because, again, we're still in a bull market. I will say...
Actually, on that, I wonder if the contrarian signal works better if everyone's bearish versus when everyone's bullish. I don't know.
It's more emotion. There's much more emotion in a bear market. People get excited in a bull market, but that is, I mean, and I get it. People say, oh, this time is different. And, now we've got AI, we've got computers, you've got a phone that gives you more technology, more information than the President of the United States had just 4 decades ago. We get all that stuff, but emotion is the one thing that doesn't change. Someday you have AI doing all this stuff, but even then, I don't believe it. I think it's always going to be emotion. I will say this, small caps, right? We've liked small caps, talked about it a lot. Up, Russell 2 up almost 11% last month for a really, really good month. There were 20 other months, so the small caps gained at least 10% during 1 month. What happens next? Right, 6 months later, up 90% of the time, up well over double digits. 1 year out, up like 15, 16%. So again, what we just saw in November, is it the start of a new bullish move? No, we've been in a bullish move for a while. But maybe with small caps, it very well could be. So maybe the market, because people talk about the market, the market's this or that, but maybe small and mid kind of continue to be strong like they have been the last 6 months of this year. Look what's happened. First half of this year, small caps are flat. We get it. Frustrating. Believe me, it was frustrating for us. We had money in it, so trust me, it's frustrating. But the last 6 months, boy, they've done really well. I'm going to get a drink of water. What's your take on small, mid, that whole theme in the next year?
I connect that to the economy. Look, if the economy is doing well, which is what we expect, and especially with policy opportunities, both on the monetary policy side with potentially rate cuts, and the fiscal policy side, tax cuts, deregulation, things like that. Yeah, you should see more economic growth. That's a positive tailwind. And if you get more economic growth, you should see more broadening out. It shouldn't be just a few stocks, a few sectors, or one sector or 2 sectors that's doing well, right? So, I think from that perspective, small and mid caps may be the place to be.
Yeah, I'm in that camp. We've been in that camp, so I think that makes sense. If you want to hear the latest from us, don't forget to subscribe to our podcast. You can also leave a review. We love your feedback, and that helps us with the algorithms to help this podcast. And then let's see, it's facts versus feelings versus is VS, facts versus feelings at carsongroup.com is our email. I just realized Chelsea used to check that email. I wonder if Drew's checking that email. Drew, we better be checking that email. Anyway, I'm pretty
sure I quoted that email last week. So.
You did. I like it. We should point out our email.
Yes.
So send us a note and let us know what we're doing, and maybe we'll even talk about something that's out there. All right, Sonu, so that's that. I didn't get the chance to talk to you. I know listeners a little bit. India was fun, though. You glad to be back?
Yeah, I'm glad to be back because, I flew over some troubled areas of the world.
Oh, my.
Between the Middle East and,
wow.
even Europe for that matter. But no, it was good. It was fun seeing, my sister and baby. My nephew is 1 year old. He turned 1 December 2nd. So that was fun. And then my parents too. But I was traveling around and it was fun to catch up with you guys when I was out there too.
It was funny. I mean, you literally joined, I guess Barry and I did the podcast too.
Yeah.
You joined from your phone. Like, I mean,
right.
It just is just kind of a
amazing.
Small world.
You were just talking about technology, what technology can do, for us. And I am 9,000 miles away.
Yeah, there was some, I can't remember. And we talked about it on the podcast, so I guess she didn't get arrested. You did something kind of illegal for your sister. What was it? Remember she came to the U.S. or there was something she did or you did? I can't remember.
Gosh.
We talked about it. Maybe let's not talk about it anymore. Then we got in trouble. But
She's coming back in April, so maybe I'll come up with,
Okay.
Yeah,
you took like 2 or 3 extra suitcases over, right? You just took diapers and stuff. I mean, it's cheaper. Why is it cheaper to do it here? Why did you? I mean, get serious for a second. Why did you had to go to like Sam's Club or Costco to buy stuff? Why is it better to do? I mean, clearly. Well, why did you do that?
I think it's cheaper. I think it's cheaper here, and it's just media stuff and things like that, clothes. And feel like we bought a ton of stuff from Carter's, which is my sister likes that stuff. I'm sure, you guys went there when your kids were younger.
I don't remember.
Same thing with me too. So yeah, that's
okay.
That's, what I did take back was 3. I don't know if I'm allowed to say this. I can say this because I took back 3 bottles of alcohol. I took back a nice bourbon, a nice gin for my brother-in-law.
Well, did you write it down on the customs thing or no?
And so I crossed it. I got through customs and all of that. I mean, they don't really check. I'm sure it goes through some video or X-ray something, before I even see the bags. But anyway, I get out to my buddy's house and I'm giving him the bottles. He's like, "You bought 3 bottles? I thought you're allowed to bring back only 2. How did you get away with that?" I was like, "I don't know. I thought you could bring back 3.
Close enough for government work. That's what I would say.
There you go. But he was happy. We didn't complain. No.
Yeah, well, absolutely. I don't know if I'm a felon. I don't know if I had a misdemeanor. I have a real quick story. I think I mentioned this before. We traveled out of the country 2 spring breaks ago. So let's call it April of 23. And of course, you have the kids and getting off the plane. It's hectic. And did you forget this and that? Long story short, I left my phone on the plane. I mean, I I had it on the seat. I was making sure the kids, the wife, everybody had their stuff, and I forgot about me. Go figure.
And they don't let you back on, right?
Well, it gets better than that. We get into customs. Like you go to, it's Charlotte, a huge place. You go down this escalator, all of a sudden I'm like, blankety blank, my phone. I don't have, I'm like, there's only so many places it could be. Like, oh my God, I left it on the phone. So I go up to like customs and say, "Hey, I got to go back to my phone." They go, no, you don't go back to that gate. You have to go through security. But even then, like you can't get to that gate because it's like the international gate or something.
Yeah.
I didn't know.
You got to buy another ticket on the same plane.
It almost was turned into that. I said, "You got to be kidding me." So I said, "How can I?" So I looked at this escalator. Now, take note, we took the escalator down. This escalator up was pretty darn far. And I said, the only way I'm going to get back to that gate to get my phone is to sprint up that escalator while people are coming down with bags and all this stuff. And my family was there.
It's like a movie. It's like a Christmas movie.
I think it could be the greatest thing in my kids' eyes that they've ever seen because it was ridiculous. And the opening happened, and I said, "Here we go." And I sprinted up the escalator.
Really? Wow.
In customs. Trust me, I probably could have gone to jail on this one. But, I'll tell friends on the podcast. I get up there, man. I almost fell at the top. It's hard. Try running up one of these things. It's not easy. And there are people coming. I had to dodge them, O.J. Simpson, a bad example. O.J. running through the airport and everything, kind of felt like that. Then I get there. My phone was just right. They had it. So, oh, thank God. Then we get back, and by this point, like 2,000 more people to spring break had probably gotten in front of us. My family's furious because it took so long for me to get back. And
they're waiting in a big line.
The line kept getting longer and longer and longer. And I got my phone back at least. So anyway, so be careful, all those travelers out there. Don't forget your phone. Because it's one thing again in an airport, but to go through customs like that. So I know. Let us know. Facts versus feelings. What laws did Ryan break when I ran up an escalator and leaving customs? You're not allowed to leave customs. All right.
That happened to me in India, actually. Not to go up. Like we're on that full thing here now. So it's all coming out.
We're way off. Where did you break the law?
I did. No, this was last year when I went to India. I left my Carson West on the plane, and then I found out I was through immigration. I couldn't go back and get it. But then I told I was traveling in Qatar Airways, I think. I told them, and they kept it for me. I was traveling back here to the United States a week later, and they had it. They had the jacket for me at the check-in counter.
Wow.
So, there you go. Very good service.
I would assume someone wanted to just steal it and wear it. That's good. If you're wearing it, by the way, on the YouTube channel, his son is wearing his St. Louis Fed shirt there. That's another good one. I don't know. I mean, we've gone so far off the rails in this one. I don't know what we're doing. Let's talk for another 10 minutes and shut up.
All right.
All right. So economic data. Last week, the monthly jobs number came in. Remember, we saw a drop because it was up, but up like only 12,000 in October, and it'll get revised higher. Listen, hurricanes and all types of stuff happened. It looked to me, Sonu, and the market, I guess, for that matter, that we bounced back nicely. What did you see when you had a chance to dig into that employment data we saw last Friday?
It was a little mixed, and I guess, underline that by saying that's why the odds of a rate cut in December, a Fed rate cut in December, went up from about 70% to 85% or so. But look, the November report was always going to be hard to figure out because it came after the October report. And you had the post-hurricane bounce back in November, the strike resolution at Boeing. The good news is we did get the bounce back, right? So that, absences due to weather, this is something the BLS puts out there. It pulled back to about 62,000 in November. It was 512,000 in October, right? So in the corresponding number a year ago, when things are sort of quote-unquote normal, was about 68,000. So safe to say we've normalized as far as weather is concerned, right?
Okay.
But there was bad news offsetting that elsewhere. We also got the JOLTS survey earlier last week, the job opening and labor turnover survey. So let's talk about all of that, right? So payrolls, solid place overall, or kind of solid, I should say. Grew by 227,000 in November, expectation for 220,000. But we also got upward revisions. Remember, everyone's been talking about, look at all these negative revisions for jobs. But look, October revised up from 12,000 to 36,000. September revised up from about 223,000 to 255,000. That's why you take the 3-month average, just like Ryan, you took the 3-year average for new highs for the market. You take the 3-month.
And when I ran up those steps, I did the average. I did 3 steps at a time.
There you go.
There you go. Yeah.
It's a magic number 3. But take the 3-month average. And we were a pretty healthy, pretty solid 173 jobs created per month, right? Before the pandemic, 2019, it was about 166,000, right? This may be on the higher end of the range. I think I expect going into 2025, I think we'll probably be between 150, 175,000 jobs a month, right? But where things weren't so great is the household survey, which is where the unemployment rate comes from. The unemployment rate picked up from 4.1 to 4.2% over the last year. A year ago, for perspective, it was 3.7%. So things that are going in the wrong direction. Maybe the glass half full view is that it's going up only slowly and in fits and starts. But the other thing you and I like to look at, we've talked about this, is something called the prime age, 25 to 54 years, employment population ratio. It gets around the fact of we're aging population. So looking at prime age workers makes sense. And then the unemployment rate as labor force participation methodology issues, like who's counted as unemployment. Unemployed. It's only if you're looking for a job that you're counted as unemployed. If I'm not looking for a job, I'm not, right? Okay. Even if I may want a job. Anyway, the employment population ratio gets around that prime age workers. That's pulled back to 80.4%. It was 80.9% a couple of months ago. So this is, could it go back up again? Yes. And I'm hoping that would happen. But again, the downtrend is concerning. By itself, look, if we stop here, if we stall out here, I don't think it's a bad place for the labor market to be at, but it's the trend that's the problem, right? And the big picture is, look, hiring slowed down. This gets to the JOLTS report, right? JOLTS measures something called hires. It's gross hires, right? How many people are being hired every month? hires are down to about 5.3 million. It was much higher than that before the pandemic. Remember, we have a bigger labor force.
I see how you did that. Hires were higher.
Hires.
I got you.
Yeah. But look, the hiring rate, which is hires as a percentage of the labor force, that's down to 3.3%. That's the weakest pace since early 2013, excluding the COVID years, so like 2020, April, May, and all of that. So for context, look, the average hiring rate in 2019 was 3.9%. 3.3 is below that. So what does it tell you? It's hard to find a job right now, right? And this is gross hiring, right? When we just talk about the payroll report, 227,000. That's actually net hiring. Why is net hiring solid? That's because even though hires are weak, separations are low. Quits are low, layoffs are low. Quits picked up a little bit in October, but quits are generally on a big downtrend as well. And when do people quit their jobs? Only if they think they can easily find another job, right? So the whole fact that the thing that quits are coming down tells you that hiring is also eased. The good news, the best part of the labor market, I think, with respect to the data, is that layoffs are low. You see those initial claims, things like that. But even the JOLT survey, layoffs are at 1.6 million. Before the pandemic, we were close to 1.8 million. And again, we have a much larger labor force now. So the layoff rate is at 1%. That's below the 1.2, 1.3% we were running at before the pandemic. So big picture, if you have a job or if you're casually looking for a better opportunity while being employed, not a bad place to be in. It's a pretty good labor market. Your wage growth is strong as well. So you're seeing all of that. But if you're unemployed, it's harder to find a job now than it was a year ago, 2 years ago. So I think that's the way I would frame that whole picture.
Well said. And again, just because there are some cracks, just because things are slowing a little bit, that doesn't mean you have to just go into a recession.
Yes, exactly.
This economy's been growing for a couple of years now. This bull market's been going for a couple of years now. We've talked before about the third year of a bull market. It can be a little choppy. It can be a little sideways action. Not the end of the world. I'm not talking about the economy here, but hey, after the economy grew as much as it did, maybe you could have some parts that aren't perfect. I will say also the challenger layoffs. This one seems more volatile. I don't know, but at least it does to me. But we saw an increase only slightly, according to the challenger layoffs last month. And I had one other stat here. It's right about the average, right? I think it's at 58,000, which is about the average number of layoffs we've seen in the past 12 months. So again, hey, it is what I could say this much. You go to carsongroup.com and somewhere on there we've got careers. We're hiring like crazy. We've got 2 positions open on our research team. So you want to work with Sonu and I, go feel free and check out that. So there are companies that are growing out there.
And speaking of the economy, you just mentioned the economy. What is the economy ultimately running at? Consumption. Where does consumption come from? Income, right? So if you look at aggregate income growth, so income growth across all workers in the economy, last 3 months, that's running at a 5.8% annualized pace. September, October, November. That's really strong, right? So that's positive for nominal GDP growth. Now, aggregate income growth is being powered by, 3 things. It comes from 3 places. Employment growth, wage growth, change in hours worked, right? Employment growth, like I said, it's going to be around 150, 175,000. That's a big pullback from the 250, 300,000 we saw a year and a half ago. But I think it's wage growth, right? Wage growth is what's powering, aggregate income growth. The good news is that because we have productivity growth, that wage growth should not translate into inflation. And hopefully that means we see rate cuts.
Well, that'll be the next conversation. We'll go there in about a second or two about that. But I do want to point out Black Friday spending, according to MasterCard, something called Spending Pulse. But again, MasterCard data. Up 3.4% year over year. That's, I don't know about inflation, so they tell us. Although I think real inflation is a tad lower, but up 3.4% year over year, not bad. It's in stores up less than 1%. Online, Black Friday, up 14.6%. Adobe said online spending was almost $11 billion, up 11%. So again, those are some real data points. People have jobs. People's incomes are still solid. People are not getting laid off.
They're buying stuff.
They're buying stuff. Again, it's not perfect out there, but after 2 years of an economic cycle of growth, and honestly, it's an election year. There are some companies that are just want to kind of wait for the election. It's late in the year, so we'll see. First quarter, maybe things should change a little bit more animal spiritsy, if you will, on the economic front. I think that's possible. So now let's wrap it up. We've got like 5 minutes or so. The Fed, it has a interest rate decision coming up next Wednesday. You talked a lot about the economy. I guess we have some inflation data coming also, but you already talked about productivity. You want to wrap it up I guess it's like 88, 89% chance of a Fed cut at the time we're recording this. I think that's the camp we'd be in. They probably take a pause in January. Maybe it's they cut and just take a break and everybody's happy. What do you see in your crystal ball?
I think that's what it is. I think they cut in December, but they take a break in January. My hope now, and this is where the risk happens, right?
Yep.
My hope is that they continue cutting in March and then maybe May or June. But I don't know if that'll happen because, there's a chance that inflation, for idiosyncratic reasons, things like stock prices pushing up portfolio management services, the businesses we are in, that keeps inflation elevated. We've talked about shelter as well. So there is a risk that they cut in December, which is good, but they pause in January and then they pause for an extended period. I don't think that will happen, but it's certainly a risk out there. But then that gets into the whole impact of what does it do to the dollar? Because the rest of the world, we can talk about that too. The rest of the world is literally burning in some ways. And that means what? The U.S. economy is stronger than everybody else, which means if the Fed cuts now, but stays pat for some time, whereas everyone else is cutting because the economies are weak, the dollar continues to strengthen. I don't think that's a good thing. I think that's a risk out there. I don't think that's not even my base case, right? That's not even my base case. I don't think the dollar appreciates much more from here, but it's certainly a risk.
Well said there. We've talked before about some risks. You and Barry talked about it in our blog, carsongroup.com/research, talk about some of this stuff. A stronger dollar, much stronger dollar. Dollar can be kind of strong-ish, that's fine, but a much stronger dollar usually means it's a risk-off scenario. The first 10 months of 22 was like the best first 10 months ever for the U.S. dollar. Stocks and bonds were obliterated the first 10 months of 22. That's one example. I'll never forget in early August when we had the yen carry trade unwind and a lot of fear. A lot of people were very worried that the yen carry trade was going to be that the end was near, is what they told us back in early August. You said, but the dollar's been lower. Like, if this is a true big worry, the dollar would be higher. And I was like, wow, I agree with you there. And we talked about it on this very podcast that actual week, or at least the very next week, when people are still thinking the yen carry trade was going to do us in. And it did not. So you think quarter point cut, 25 basis point cut.
25 basis point
and
cut.
And they'll leave the door open for more, but probably not going to be 6 weeks from now.
I don't think we see January, but my worry is we may not see March. I hope that's not the case, but we'll see, right? There's so much happening. It feels like just last week, it was like we got 2 decades worth of political events happen in 1 week. Everything that happened in Syria, over the weekend, which is great. I mean, Bashar Assad was a monster, but the rebel group that overthrew him was like this guy who was former Al-Qaeda member, Abu Muhammad al-Jalani, joined Al-Qaeda in Iraq in 2003 to fight the U.S. He's moderated his views, so they say, but I don't know. It's a mess. And then Korea, right? Martial law in one of the U.S.'s biggest biggest allies in
South Korea.
South Korea. Like, they had dysfunctional politics. The president couldn't get anything done. His party lost big in parliamentary elections a few months back. The opposition got a huge majority. So he was the first South Korean president in decades who had to deal with an opposition-controlled parliament for his entire time in office. What does he do? He said, I can't get anything done, so I'm declaring martial law. That's what happened last Tuesday. He banned all political activities, party activities, rallies, things like that. Said all news media publications would be under the control of martial law command. But the assembly, which interestingly enough, the assembly was able to vote it down. So they unanimously voted to overturn it within 2 hours. He also pulled back in about 5-6 hours. He voted to, he said, okay, I'm going to lift martial law. What was interesting is he came on TV. I don't know if you saw this. He said, he deeply bowed, right? And he said, I offer my sincere apology to the people, and that this came out of desperation. It was extraordinary stuff, right? Then he faces an impeachment vote, but that was voted down. So he's still in power. The Kospi index, the South Korean index, is down about 5% since then. Then we had dysfunction in France, right? I mean, the French government collapsed. And again, Macron had appointed a government and parliament. I mean, he opened the door for elections several months back, June of this year, and his party lost. The far left was the majority, but they didn't have an absolute majority in parliament, so they couldn't form a government. So Macron asked his people to form a government. That government collapsed. Why? Because they were trying to cut the deficit, right? The deficit in France, about 6% of GDP. Now, apparently in Europe, if you're part of the EU and if your deficit is above 3%, and they'll give you a warning, but at some point they'll put you under excessive deficit procedure. That's literally what it's called.
That sounds terrible.
And if you don't meet the deficit target of 3%, they can put sanctions on you. So anyway, Macron's people, Michel Barnier and his team, worked on a budget to bring the deficit down. The far left and the far right, ironically, both of them came together and said, no, we're not doing this. We don't want tax hikes. We don't want spending cuts, right? To bring the deficit down. So they put through a no confidence vote. The government collapsed. And it all goes to show that, the U.S. is still, the dollar especially, clean a shirt in a dirty laundry.
Well, I did see President-elect Trump and Macron handshake the other day. Boy, that's interesting. Yes. Go watch those two whenever they try to shake each other's hand. They're always trying to one-up each other and turn into like thumb wrestling, and I don't know what was going on there. That was interesting. Yeah.
But I think this all it gets back to the risk of the dollar, right? Like, and the dollar, 58% of the dollar index is Europe, right? It's a euro. So Europe matters. If France is not going to be able to grow its economy, let's say they have austerity, what's the ECB going to do? The ECB is going to cut rates, but while the Fed is still got elevated rates here, that rate differential is going to grow. It's going to push up the dollar. I don't know. Again, like I said, that's not my base case, but it's a risk.
Yeah, no, it's something we'll watch every single week and continue to talk about it. But definitely great discussion there. We covered a lot of bases. Yeah. It is December. It is getting a little colder out there. Hopefully
but ironically, the Bears are coming out of hibernation before.
The Bears are. That actually might have been a better title for this podcast. The Bears are. Maybe I'll use that for a blog. I'm writing a blog on. Maybe I'll say that the Bears are out of hibernation. I like that that'll be my blog post. So by the time people listen to this, go to carsongroup.com/research. My blog will be there. Maybe using that title. The Sonu just came up with. So anyway, with all that, everybody, thank you for listening to episode 113 of Carson's Facts versus Feelings. The title again was Now the Bears Turn into Bulls. And it was fun. We'll be back next week, right? We were trying to come up with the schedule. We'll be doing these at least the next several weeks, maybe take a break around the end of the year. We'll see. I don't know. Who knows? Maybe we'll just keep doing them. So with all of that, everyone, thank you for listening. Give us, what we say again, review the podcast, subscribe, give us feedback. We appreciate that. And we'll see everybody next week. Thank you. Take care.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.